Good morning, ladies and gentlemen. Welcome to the Queen Elizabeth Hall. My name is John Preston. I'm the chair of the London Pensions Fund Authority, and I'm delighted to welcome you here today. Before I introduce today's agenda, there are just a few housekeeping points that I need to take you through. For those of you attending in person, please note that there are no fire alarms planned for today. So if the fire alarm does sound, please exit the venue through the marked doors to the right and left of the venue. I'm very sorry to say that although we planned to have this event captioned, our captioner has unfortunately had to cancel literally at the last minute, and therefore we don't have a captioner available today. If you need to, there are some seats at the front with some printouts of today's presentations, which you can please move forward and read. And we are videoing this event, and when the event is issued as a video, it will have captioning available for those of you unfortunately not able to hear today. But the auditorium does have an audio loop, so if you need to, please switch your hearing device to setting T. There's no phone signal in the auditorium, but you can access free Wi-Fi, and I'll say a little bit more about that in a second. And when we break for tea and lunch, can you please exit the auditoriums through the exit and entrances at the middle of the auditorium as opposed to the ones at the back or the front? The middle will take you back to the main auditorium where tea and coffee and lunch are. And in the foyer, you will also find the stand hosted by our colleagues from the Local Pensions Partnership Administration. They're here to assist anyone with any general queries they have about their personal pension or their retirement, to help anyone who wants to register with our new member portal, Pensions Point, which I would encourage everybody to do. Virtual attendees can find out more information about Pension Point by following the link that I will put on the screen there. We're also filming this event, as I say, and you may be asked by roving cameraman during the course of the day to participate in a vox pop to get your views on the LPFA and the event. The Wi-Fi is on your screen. That's the name of the free Wi-Fi service. If you do need help accessing any of the facilities here today, please just ask a member of staff. But we would be grateful if you could switch all your phones off during the presentations out of courtesy to our speakers. Housekeeping for virtual attendees. If you're attending virtually, if you have any questions of the presenters, please use the chat box in the main section. We have had a lot of questions that have been submitted prior to this event, so we're unlikely to be able to respond to all of the questions submitted today. But can I emphasize, please, if you have a question about your own personal pension, please visit the LPPA colleagues either in the forum or if you're attending virtually, please call the help desk after the event or use the link that I put up on the screen a little minute ago. And please do not share any personal information in the venue's chat box other than your name. If there are any issues with the technical side of things or with the streaming, as I say, there will be a recording of the event which will be hosted on our website for you to watch later. Let me just briefly go through today's agenda. I'm delighted to say we've got a packed agenda today. We'll be providing a review of the year, an update on our investments and the administration of our fund, and also talk about how the LPFA is impacting upon society. And there will be a chance for audience members to ask questions later in the day at a panel Q&A session. Now that my housekeeping duties are over, I'd like to say how delighted I am to see so many people here at the South Bank Centre. And I'm also delighted to welcome the hundreds of members that are joining us online in our virtual event space. It's a great source of pleasure to us that all of you, our members, continue to show such interest in the LPFA, the work that we do, and our progress. Now, the most important thing I'd like to say today is that we continue to go from strength to strength and that your pensions are safe. You will undoubtedly have been listening to the news, reading newspapers, and read some really quite scary headlines. But this is not, the issues that have been highlighted in the press are not issues that are relevant to the LPFA. And as we'll talk about more today, your pensions are safe. Financially, the LPFA fund is in good health and was valued at £7.6 billion as at the 31st of March 2022, which was our last financial year end. That's up from £6.9 billion at our previous year end, which we talked about at last year's members' forum. Our investments are also performing well, beating the targets that we've set. And whilst clearly there's been extreme financial volatility in the markets over the last few months, we remain in a strong position. Richard Tomlinson, the Chief Investment Officer of our investment manager, LPPI, will say more about this a little later on. I'm also delighted to say that we continue to save money. The LPFA have saved over £19 million in asset manager fees since pooling took place in 2016. We're also rolling out improvements to our member communications. This ensures that we're communicating and reporting on our progress in as transparent and simple a manner as possible. As the LPFA, we have two main priorities. The first is to make sure that we have the resources required to pay your pensions, and the second is to ensure that we are a well-run and efficient fund, meeting the needs of our members and our employers. I'm delighted that Richard and Joe Derbyshire from LPPI and LPPA will be outlining the steps that their investment and administration teams, respectively, are taking in support of these objectives. And I'm sure that you will be pleased at the progress that their teams have made. Of course, while good things are certainly happening, that doesn't mean that we aren't still facing challenges. COVID-19 is still claiming lives, and we're all grappling with the uncertainties and stresses caused by the cost of living crisis and the implications of international conflict. So, with everything taking place, it is important that I take the time to reassure you that your LPFA pension is safe and guaranteed. The local government pension scheme, of which our fund is a part, is a statutory defined benefit scheme. That means that the retirement benefits that you build up whilst you're working are guaranteed and inflation-linked. Unlike, say, a defined contribution scheme, your pension payments in a defined benefit scheme are guaranteed by the scheme regulations. They don't, unlike a defined contribution scheme, depend on the value of the fund's investments. So whilst I fully understand that headlines about looming recession and market falls can be very worrying, you can be confident that it won't impact on what we pay you each month. If you are still worried about the impact of recent financial difficulties on your pension after all of the presentations we have today, then please do ask a question in the panel Q&A session later on, and we'll address it again. And Robert will be talking further about this certainty later on. But I did want to stress that your employers are members of the LPFA fund, in part because they recognise what a valuable benefit this certainty in retirement is for employees. Employers recognise that the value that an LGPS pension has in motivating and engaging their employees. And it's worth saying here that we've actually seen an increase in interest from other employers wanting to be part of the LPFA fund. And we think it's encouraging that the value of an LGPS pension is recognised by employers and employees alike. And it's a testament to the team's work that the LPFA is considered to be a well-run fund and attractive to employers. Now let me turn briefly to responsible investment. We know from our members' survey that you want us to be a responsible investor. You also said that it was important that we take action on climate change. I'm sure you'll be pleased to hear that in September 2021, we committed to being a net zero pension fund. And if you visit the transparency dashboard on our website, you'll see that we no longer have any extractive fossil fuel companies in the equities part of our portfolio. We did, of course, cover climate change in considerable depth at last year's forum, so it isn't a focus for today, but it remains a key focus for the LPFA board, and in the coming weeks, we'll be publishing our Net Zero Action Plan on our website. This sets out how your fund will be part of the movement to a low-carbon future. And I'd like to encourage you all to visit our website, lpfa.org.uk, over the coming months to see how the LPFA is tackling or helping tackle climate change. And finally, before I hand over to Robert, just a reminder about the London Fund, which we set up with others at the start of last year and discussed at last year's forum. It's a key part of our commitment to London's future. Its purpose is to invest in London's future whilst, crucially at the same time, providing an appropriate level of income for the fund. It seeks to invest in affordable housing, community regeneration projects and infrastructure, including clean energy and digital services in the capital. And you'll hear more about it later. You'll also hear about the value that the LPFA brings to society. The London Fund is the most obvious link between the LPFA and how we invest in the communities in which you live. But you'll see, however, that the LPFA impacts on many parts of the UK, not just London. We may be the London Pensions Fund Authority, but we invest in job creation, infrastructure and real estate across the United Kingdom and beyond. We hope that the information in all today's presentations provides a useful insight into what we're trying to do, the progress that we've made, and our role in society. And just on a final point, can I please remind you once again, if you have any specific questions about your personal pension circumstances, you should direct those to our administrators, LPPA. You'll see their desk in the foyer, or you can follow the link that I published yesterday. They'll also have staff on hand through the day to help you register with Pension Point. Thank you for your attention, and I'll now pass over to Robert Branner, our Chief Executive.
Good morning, everyone, and can I offer you my welcome as well to your 2022 Fund Member Forum. So I'm going to do a session on a look back over the year and try and give you some further content on why we think we are a well-run, transparent pension fund. Before I get into some of the detail, though, I am going to give you a flavour of who is in our fund and outline what they do. So you'll see the map of London on your screen in front of you. We have 94,000 members in the fund, and it's approximately 60% female and 40% male membership. 20,000 members are actively paying into the fund. The majority of those are working and living in London. 38,000 are pensioners or dependents, and 29,000 members are deferred or have yet to take their pension. In total, we have about 10,000 more members than we did in 2018. So in this session, I want to talk to you a little bit about who you all are and the part you play in London life. So in this slide, you have some examples of our educators in London. You'll see a number of organisations that you should recognise, and we have roughly 22, 23 primary schools, 9 academies, 11 further education establishments, 13 higher education establishments, and 3 independent schools in the fund. We're paying the pensions or growing the retirement savings of around 40,000 people involved in educating London's future workforce. Our members are educating 15,000 students at Brunel University in Uxbridge, 600 students at the London Nautical School in Blackfriars, about 1,000 teenagers in the Cardinal Vaughan School in Holland Park, and 25,000 adult students in the City Lit in Holborn. But our members are also supporting London's civic life too. We have over 17,000 members working to improve public life for our communities, working amongst others at the London Fire Commissioner, the Food Standards Agency, and the Olympic Park Legacy Corporation. Our members work for organisations as diverse as London is itself. From the widely recognised GLA to perhaps the less well-known East London Waste Authority, which as an example provides disposal of waste for London boroughs of Brent, Ealing, Harrow, Hillingdon, Hounslow and Richmond upon Thames, truly cross-London activities. We also have about 400 members working in social housing organisations. And again, you should recognise some of the names here, from the Peabody Trust to the Guinness Partnership. We also have a sizable community of members in charities. We have nearly 3,500 members who work for over 16 charities in our fund. 700 members work for SAFA, the Armed Forces charity, and 400 of their volunteers provide direct mental health, finance, and other support to the UK military personnel and dependents. We have 20 members working for the wonderful Corums Fields organisation, which is an oasis of calm for children in Holborn, in the centre of London. We have 250 members working for the Horniman Museum in Forest Hill, where visitors can still look at over 300,000 artefacts, their aquarium and beautiful gardens for free. And I'm telling you all this because LPFA doesn't just work for you as a pension fund, but we think we work for an array of London workers. So that's who's in the fund and who we support and who we work with. What's our objectives and why are we here? Our primary purpose, as we say to you each year, is to pay pensions. That's why we're here, and that's what we think we do quite well, and that's what we're charged with doing for the next 10, 20, 40 years. To do that, we must generate income from our investments, but we also must manage risk to our fund. Risks like climate change and the impact of war have a financial impact on all pensions, but we continue to improve the way we are run and to seek ways to save money in those circumstances. We also must continue to improve our approach to responsible investment, and that's an area that you've asked us to concentrate more on in the past. And last but not least, we also continue to seek to collaborate. So one of our main strategic themes is collaboration with other organisations and other funds. We know that collaboration can deliver savings for our members, generate new ideas for the fund, and help share our thoughts with others as we learn from them as well. So I'll briefly just go through the 5 areas to summarise what we've done in the last year on your behalf. So in paying benefits, Joe and Richard will give a lot more detail about this as they make their presentations on investments and administration. But I wanted to make some initial points. As John said earlier, the fund is now worth 7.6 billion, up from 6.9 last year, so returns have been good. We collect over £105 million a year in contributions from those employers I showed you a few slides back. We also collect approximately £50 million a year from employees contributing into the scheme. So that 153 million of contributions, together with the returns from our investments, essentially go into paying out pensions to the value of 18.7 million a month, or roughly £224 million a year. So there's some inputs, and then the outputs is the continuation of paying your pensions. So this leads us on to objective 2. As we continue to pay your pensions, how do we manage some of the risks to the fund? We manage risks on a day-to-day basis, and we manage risks strategically. We all know about recent market movements and the cost of living crisis, but as you recall, an LGPS pension, and John referenced this at the beginning, unlike many other pension systems, is linked to inflation. This helps you as your pension will rise as inflation does, but it also means that we have to be very focused on managing this increase in demand for more cash for pensions. We are, just to reiterate, in very good financial health. We are more than 100% funded, and this is a measure of whether we think we have enough money to meet the liabilities and reflects how well we are managing risks in the fund. Richard will look at investment risks in more detail, but my main point from this slide is to say that our investments are performing well, we are managing the day-to-day and the strategic risks of the fund, and we are meeting this increased cash flow demand we have at present. So let me move on then to climate change. And climate change, as we all know, poses an increasing risk to society and, of course, is a risk to the financial health of the fund. We are due to publish our climate action plan in November. As those of you who attended last year will recall, we decided to make a commitment to net zero by 50 and significant progress by 2030. And we've had this year, since we last met, to come up with our plan. So that plan is in its final iterations and due for sign-off and will be published in the next 4 to 6 weeks. Over the next year, we'll be focusing on climate action in our listed equities, or our stocks and shares, if you want to think of it in that way. And that is the major part of the fund. That is at least 50% of the fund, those assets we hold in stocks and shares. And whilst we no longer hold companies extracting oil and gas in the equities portfolio, it's important that all companies we invest in, from IT to consumer products to transport, have a net zero strategy in place or a plan to reduce emissions or to be in the transition phase to a better place. LPPI, so the investment business, will be meeting and engaging with those companies to help them do this and encourage their move in the same direction. This last point is important for us because although we're committed to transparency, we do want to share with you some of the work we're doing, and some of that is now on the website, and we'll be doing more communications on that as we make progress over the year. So being a well-run and transparent fund is where we started this brief presentation. Away from risks and investments, we continue to strive to demonstrate that we are looking after you and our employers in a well-run manner. Those of you who attended last year will recall me saying that we had taken quite a lot of work back into the team. So we've developed and grown the team, and we now pretty much run all those functions of a large, well-run pension fund, as you would understand it. There are 4 directorates or 4 areas of the LPFA, if you think of us as a business, and we now employ about 20 staff, and they're across finance, legal and compliance, investment and risk, and corporate services. We have a 5-strong employer management team which looks after our employers alongside LPPA and the work they do for our employers as well. Whilst this has increased governance and oversight costs a little, the cost of administering the fund is approximately £63 per member. And to give you some contrast, before 2016, the cost was about £93 per member. We've also saved around £19 million in asset management fees since pooling in 2016 as well. The final point to say on this slide, in terms of transparent and well-run, is we're pleased to note that complaints in the administration service in the year have also decreased, and we're down to about 93 in the year to March, having been about 162 the previous year. We continue to work with Jo and her teams to try and get that level below 100. So a little bit more about the structure, because I recall last year I got a chuckle from many of you when I said there were too many L's involved in LPFA, and LPPI and LPPA and LGPS, and I could go on. So this slide is just a brief resume of the structure of the organisation and hopefully helps demonstrate some of that, how we think the fund is run efficiently and well run. So when pooling started in 2016, all of the 88 England and Wales local government pension schemes had to move into one of 8 defined pools. Ours is the Local Pensions Partnership, and Richard and Jo are here from LPP, and we have an investment business, LPPI, and an admin business, LPPA. If it makes it easier, for the last few minutes of this presentation, I'll say the admin business and the investment business, just to save saying L's all the time. The LPFA board and the local pensions board oversee our work as well as the work of the LPPA and LPPI, and the local pensions board works closely with us to ensure that member and employer needs are met and that the fund continues to be well governed. We've also invested in a few new team members within the LPFA team, principally a new compliance manager, a new governance manager, and that's alongside concluding bringing pretty much all the corporate services back in-house over the course of the year. We've also refreshed the LPFA board with some members coming to the end of their normal terms, and we've welcomed some members with experience in investments, in administration, in climate change, and in governance. So one of the things that is very useful for us in occasions like today is to get feedback from yourselves. So not only do we enjoy meeting with you and hearing some of your thoughts on how we're doing and what you'd like to see in the future, but you recall you also contributed in significant numbers to the member survey a year and a half ago now. And we spent a lot of time trying to respond to those queries, comments, observations you made. And I think approximately 3,500 members, maybe some people in the room, actually responded directly to that survey. Most pension funds in the UK get a response rate of between 2 and 3%, and we got nearly 10%. So thank you for your contribution. And I hope today you see a demonstration of some of the listening and some of the changes we've made on the back of your feedback. Some of the things you told us was you wanted information in a more simple and less jargon-heavy way, and hopefully today we'll demonstrate that we're trying to use less jargon. You told us you wanted more information, particularly around responsible investment, and you also wanted to know how the fund was invested. So Joe, I know, is going to talk about how the admin business communications have improved and evolved over the year, but as a fund, I think we are spending a lot more energy sharing stuff on LinkedIn or on Twitter. We're making more use of videos or animation to try and demystify some of that language and some of that jargon you said you weren't happy about. We've put a dedicated section onto the website to help members track our net zero and our responsible investment activity. And we will evolve this further when we get further feedback from you in terms of sharing more information about our investments. We've also introduced a twice yearly LPFA fund news email. And of course, we have this event each year where you kindly come and share your thoughts and hear our progress. As I mentioned to you before, many of you wanted to know a little bit more about how we're invested. So in March this year, we partnered with a fintech company called Tumalo to launch a transparency dashboard. This is different to the pensions dashboard you may have heard in the news, as this is really so that you can look at our website and simply and easily find out what stocks and shares or companies that we are invested in. We were the first LGPS fund to do this, and it got a lot of attention in the industry press and from stakeholders who are interested in net zero and climate change, and of course, with many visits to the website from members who are interested in seeing where we hold our investments. Again, I would encourage you to look at the website and give us some feedback as to how that's landing in terms of our transparency. The next stage of our communications plan covers 4 main areas, all of which are aimed at trying to improve our service for you, our members. We'll be supporting LPPA and encouraging members to sign up to Pension Point, so you'll see some colleagues outside. So if you haven't signed up to that, please feel free to do so later. We're also working to improve our data, and we're also targeting members who have left but have still got entitlement in the fund to see if we can connect with them and keep more in connection with them for updates on the fund and their details. We're also continuing with hard copy communications because we're conscious that not everyone prefers online or email correspondence. And we will, of course, as I said earlier, spend a lot of time telling you what's happening with our net zero plan and our commitments on climate change. So speaking of climate change and responsible investment, the 4th of those objectives I touched on at the beginning was around investing responsible for the long term. So what does it mean when we say we want to be a responsible investor? What that means is that at every stage of the investment process, we seek to assess those investments to make sure that they are being managed responsibly. Our investment managers assess a company using a range of criteria before we invest in them, and they speak to them and monitor their progress whilst we hold that investment. That, in essence, is what we mean by engagement. And the list above is the areas in which we spend some time discussing, or our asset managers spend some time discussing with those organizations or their boards or their investor groups. We also work with other external organizations. For example, there's an organization called the Local Authority Pension Fund Forum who do a lot of voting and do a lot of work in this space, and we are part of that community. We also report on our transparency dashboard and an RI dashboard, as you can see here. So again, we're spending more time publicizing for you how we're progressing, how we're doing. This dashboard is a start. so it will evolve. But again, we would love some feedback from you as to whether or not this is giving you the type of information you would like. We're also investing in a new responsible investment manager for the fund, and that person will be starting with us next week, initially to start improving the communication, but then to evolve and help the board move forward with our strategy when we do a review next year on RI. So finally, let me just touch on collaboration. It's hugely important to us that we collaborate with other funds, with other organisations, with stakeholders in the climate change arena. We do not think we have all the answers. We know we do some things well and we want to share that, but we do like to learn from other people, and we do want to contribute to the wider pension system and the wider local government environment. We speak at events and conferences. We were represented at COP last year. We speak regularly at industry events on climate change and on governance, and we spend a lot of time engaging with stakeholders such as Make My Money Matter or Climate Action 100 to tell them what we're doing and find out what they're doing and if we can do some more. We also invest collaboratively, so I'll frame my next couple of slides on two major areas where we collaborate with others. The first of these is the London Fund, and you might have heard John mention this in his introductory remarks. This is a collaboration between LPFA, LPPI, our investment manager, and LCIV, which is the pool that looks after the 32 London boroughs. So this is a tripartite agreement to produce a financial return, because we need to produce financial returns, but also to do some wider good, largely in the London area. We're looking at investing in income-producing opportunities in London, be it through green technologies, energy projects, or transit, and also to help solve some of London's more pressing issues, such as affordable housing. We started the London Fund with some 100 million from us in 2020. We put in another 50 last year, and Haringey have also joined as well and put in another £45 million as well. We also participate in something called GLIL, which was established in 2015 by us and the Greater Manchester Pension Fund, and that had a significant £500 million worth of capital to spend. It has since grown to include people such as Lancashire, Merseyside, and West Yorkshire, and Nest, the national government Master Trust auto-enrolment vehicle, joined GLIL in 2021, bringing its assets then up to about 2.5 million. And GLIL is a major player in infrastructure, and as an LPFA member, you are directly investing into the future of the UK. And I'll speak a little bit more of that later on. So that's a quick whiz through how we did, what we're doing, how 2021 has been. I hope we've addressed some of those issues that you asked for last year or via the member survey. To end in a summary, I think the fund is in good financial health and is being transparent and well run. I think we can demonstrate we're meeting those strategic goals, those 5 objectives I talked you through a minute ago. We're improving the service with our colleagues at the A&I businesses, but we know there is much more to do. And I genuinely hope you think we're listening when you give us some feedback and acting on that feedback and demonstrating some improvement in communications and messaging for you. So thank you for listening, and I'll pass on now.
Good morning, everyone. My name's Richard Tomlinson. I'm the Chief Investment Officer at LPPI, or Investments, as Robert referred to us earlier, to reduce the L count. So I'm going to talk to you in more detail about the portfolio and what we've been doing and some of the outcomes that we've delivered for you in the last 12 months. So to start off with, what's our focus? In some ways, it's pretty simple. I'd argue that it's the outcomes that matter when you're a professional in the real world. It's not like being at school where if you try hard but don't quite make it, that's fine. It's outcomes that matter for us in terms of delivering what you as the members and the LPFA and the employers need, which is essentially, in simple terms, paying pensions as they fall due and managing the contributions levels or supporting the process that enables stable contribution levels for employers. The inputs do matter, the activities we undertake do matter, but it always comes back to driving these outcomes, because fundamentally a pension scheme here exists to serve the members and pay pensions as they fall due. And what are the key outcomes that matter most? If you think about it, you're contributing capital when you're working. That's going into the fund. We're investing that to grow that capital for the future. So clearly, one of our key outcomes is growing that capital base to pay pensions in the future. But also, at any point in time, we've got members who've retired, and we need to generate income to pay the pensions. So obviously, we need to generate income from the portfolio to supply that cash to enable payments to be made every month to the members in retirement. Liquidity, and this is more from managing the scheme, but this is ensuring that we have sufficient liquidity in the portfolio and in the scheme. And in simple terms, that means having cash in the bank to make payments as required to members and for the scheme administration, but also within the portfolio to mean that we can move the portfolio through time, just making sure that we have sufficient ability to manage the portfolio through time in terms of being able to buy and sell assets. I think both John and Robert have mentioned earlier the fund valuation. It was 7.6 billion as of the end of the last financial year, so that was the end of March 2022 or earlier this year. What I'm pleased to say is that currently still, or actually step back a second, I'm sure you've read many headlines over the last few days that defined pension schemes have had some challenges and some very scary headlines you may have seen. Just to reassure you that as of this morning, the estimates for the scheme is still £7.6 billion. The things that you've read, say, whizzing around on websites and other things, what I'd reassure you is to say is that those things, they are real, but they don't apply to the LGPS, and certainly don't apply to the LPFA, or to your scheme, I should say. That there have been some challenges for the last few days for some pension schemes, but those are almost all private sector, corporate defined pension schemes who pursue a different type of strategy. So just to give some reassurance, the point one, the headlines that you've read, let's say primarily this week, the issues that have been surfaced, they're a long, long way from anything that's happening within your scheme and actually within LPPI, within our business. And secondly, in terms of where the portfolio is today, it's worth around the same now as it was just almost 6 months ago at the start of this financial year, against a backdrop of some very challenging market conditions and an economic environment. So moving on to what you own in terms of the asset allocation. So we work to a strategic asset allocation that's set by the LPFA, by our client, so the LPFA's board. And in that, I won't talk at length on this. I'm sure I think we've used this slide every year. So just to give, for those of you that are less familiar, around half the portfolios in what we're referring to as public equities. That means stocks and shares. That means companies that you read about in the paper. It means companies that may be listed on the London Stock Exchange, the New York Stock Exchange, whether it's Vodafone or whoever, large businesses. You've then got around 5% of the portfolio in what is referred to as private equity. Those are privately owned businesses. Still, you're buying the equity in businesses, you're owning the stocks and shares of these businesses, but these are privately owned businesses, not listed businesses. You've got a reasonable amount in credit, so 16% in credit, so that is lending in various guises. That tends to be more private credit, so it's lending to businesses, it's lending against property, it's that type of thing, but it's a lending type activity. 14% in infrastructure, so that is owning trains, toll roads, this kind of stuff, the core infrastructure that we rely on to run the society. And as I say, a chunk of that is via GLIL, which Robert mentioned earlier, and we're essentially the investment team for that, and we're managing that activity. I haven't mentioned real estate, so predominantly that means a split between residential real estate, so privately owned, or private PRS, so private rented sector type accommodation, so tower blocks of flats, etc. There's a proportion of what you may call core commercial real estate, so offices, logistics hubs, that type of thing. And then there's an element as well in things like retirement homes, nursing homes, that type of thing as well, more specialist activities. We have an element of that. And there's a small amount of the portfolio then in cash and fixed income to provide liquidity and essentially cash to enable us to manage the portfolio appropriately. So moving on, I said it was outcomes that matter. Just trying hard doesn't always work when you're talking to your clients. It's the outcomes we get measured by. So to give just an indication of the performance of the fund, over 1 year the fund's performed very strongly. You can see there's approximately 13.5% return over 1 year, and this would have been to the end of March this year, so it has changed a little bit since then, against what we call a policy portfolio benchmark. What that means is market-based indicators of what the portfolio could do. I won't go into too much jargon, but it's essentially, if you looked for the stocks and shares elements, if you looked at what the UK stock market did, as proxied by the FTSE 100, say, and then you'd compare what our portfolio stocks and shares did, that would be the equivalent for that policy performance. So if our portfolio beat the FTSE, you'd be ahead of the policy portfolio. If it underperformed it, you'd be behind. So that gives you an indication. So over the last year, we've had significant outperformance of that market-based version of the policy portfolio. Longer term, we're still ahead, but not by quite as much. But overall, we're very comfortable with the performance of the portfolio, certainly in recent times and longer term. I've already had 1 or 2 emails this morning about what's been going on that we've been dealing with, and I'm sure many of you may have questions about what's taking place in the world. You may have read headlines about very volatile markets. You may have read headlines about interest rates, inflation. You may well have read the Bank of England intervened yesterday to buy what's known as gilts, so UK government bonds. What I'd say is that this year has been very volatile for lots of reasons. I think, the UK, we have a specific set of issues that have become more pertinent this week, let's just say. But that's against a global backdrop of challenge. Clearly, as you're all aware, Russia's invasion of Ukraine in February of this year certainly catalysed a number of issues. But it's not the only issue. That is an issue that's hit us much harder in Europe, but there are issues that are much broader than that were there anyway. Rising inflation, I'm sure that's a key concern for, I suspect, everybody in this room, because it is hitting everybody, whoever you are, at some level, at some point, because it's relatively broad. It's not just energy. It's hitting food. It's hitting all kinds of other key elements to our lives. So clearly, rising inflation is a focus. And it's also hitting in investment portfolios, because the biggest in an investment portfolio, it's not so much current inflation that's the challenge. As an individual, current inflation is the problem. But from an investment perspective, the key point is changes in future expectations of inflation and what the perception of inflation might be in the future, and that has moved significantly as well. And as part of our role as well, we need to think through what future inflation might look like, because that then impacts the investment case for all assets. So clearly, inflation is a key topic, both from a sort of individual perspective and from an investment management perspective. Central banks have started to raise interest rates. Again, I'm sure many of you will have read about this in the paper, or in the press, I should say. And some of the challenges that you're seeing now in terms of markets, investment markets, are due to that. I won't dive into the weeds, but what I'd say is central banks are clearly on what people, in jargon terms, a policy tightening pathway, or whatever you want to call it, which in simple terms means raising short-term interest rates. That then has multiple impacts. It moves the cost of longer-term financing for all assets. It can move the cost of things like floating rate mortgages. It's certainly, as I'm sure, if anyone that's been looking at mortgages in the last week or two in the UK, you'll see it's been very, very challenging for anyone looking to either remortgage or understand what they might do in the next 6 to 12 months. And there's significant policy uncertainty. All those last few points are all related. The key policy lever that central banks have is that interest rate channel, but it's impacted by an inflation outlook, and it's impacted by what you may call recession or non-recession GDP type indicators and unemployment. So it's a fairly complex scenario at the moment. Although my personal view is that I don't see central banks easing off on the policy tightening immediately. I think they're really focused, certainly the United States Federal Reserve, on containing inflation. So I don't see them backing away. Soon, let's say, they are very driven to get policy inflation under control. And I think that does have material implications around the world. So we thought it'd be remiss not to just quickly note the Russia-Ukraine, because we certainly received a lot of questions earlier in the year about exposure to assets in the Russia and Ukraine, both from a capital preservation point of view, or are we going to lose money because we have assets in Russia and in the direct region, and also from a sort of what you may call a responsible investment perspective, are we investing in Russia? And from other perspectives, I'm pleased to say that we had very little exposure to Russia, Belarus, and Ukraine coming into what you may call that crisis, or into this year. We never have had very much. Again, this is a topic I can talk about separately. We haven't got time to discuss why at this point, but it's just not in line with the way we tend to invest. So we had a tiny amount in some of the portfolios, and it's now, as we've noted at the bottom, once the issues became clear, we made a policy decision to have no new investments in that area. And as of currently things stand now, it's less than 0.01% of fund assets. So to summarise that, there was very little exposure coming into this year. It's essentially zero now, and we won't be making any new investments going forward. And as I say, part of our broader investment strategy was never to really have much exposure to those types of assets anyway. So just a little bit more on inflation. As I say, it's such a key point, as I noted earlier. Inflation levels are very high, as you're aware. We put a little chart on there, which I can't quite see the most important point from the curtains in the way, but there's a spike, I believe, according to my slide, on the this side, left-hand side, my left, your right. As you can see, that's showing CPI at around 10%, which I'm sure everybody in this room is familiar with. Everybody here must buy groceries, pay their gas bill, and all of these good things. So inflation clearly is elevated at this point in time. How quickly it comes down, how successful the Bank of England will be at getting that back to the 2% target, and over what timeline? Question mark. But it's clearly elevated at the moment. That's having a material impact on what's been referred to as the cost of living crisis and challenges. What I'd say is that the bit that I say, certainly within my professional domain, which is the bit I would focus on with wearing this hat, is what does this mean for your investment portfolio? And what reassurance can I give you that the investment strategy of the fund and that your assets are being invested in line or in a way that is makes sense with inflation at these levels? What I'd say is that the portfolio is very well positioned. We're a long-term, the LPFA, are long-term investors. We are absolutely not about chasing short-term gains or the latest hot thing. We take a long-term perspective because we are a pension fund. So we have assets that are investing over that horizon, which is very helpful. So we don't have to respond to what you might call short-term market noise in anywhere near as much of a way that some other players might have to. You've got a global portfolio. So if all your assets were in the UK, I think I'd be having a slightly different conversation with you at this point. I'd be a lot more concerned that because of some of the dynamics of the UK, there are, unfortunately, significant risks in the UK that we are going to have to navigate in the next few years collectively. But the portfolio that you own is generally global. It's very global, I should say. And as well, there are a lot of assets in there which are linked to UK inflation as well. So the domestic assets that we do have tend to have quite a lot of inflation linkage, so have benefited from rising inflation. So, as I say, it's never fun to say inflation's at these levels because it does have all kinds of consequences and knock-on implications. However, even bluntly, if I look back, with perfect hindsight, would we have done anything differently a year, 2, 3 years ago? Possibly some little things, but actually, I now feel very comfortable looking at our portfolios, even given the current outlook, compared to some portfolios that we could have had, let's say, and that are possibly in some other pension schemes. And I'd say, this is more for some other colleagues who are more in the weeds of the benefit side of it. But clearly, what I would say is increases in pension payments are linked to inflation, and we obviously pay attention to that within the investment portfolio. So we are, as I say, linking what we do to the needs of the scheme. I'm conscious of time because we are running a little late. So I'll look to accelerate the last few slides and bring us back to time. So I will, my apologies, I will just jump through some of these last few slides to make sure we get back on track in terms of timeline. I think I've largely covered much of this slide already. Key points, we've got global portfolio. We are frankly, relatively conservative with a small c as an investor. We're not chasing the latest fad. We do take a long-term perspective, and we do have a significant, the LPFA's portfolio have a significant exposure to a number of real assets that gives the portfolio inflation participation, which then helps as we're seeing inflation filtering through the system. London Fund, I think Robert touched on this earlier. All I'll say is this is a fund that we're running. We run. It's not. I was about to say on behalf of the LPF. That's not quite true. It's a fund that we manage in partnership with other groups. We manage it, as Robert noted, with the London CIV, who's another LGPS pool. It's targeted on London-based assets, real estate and infrastructure, but linked to positive social outcomes. So we're looking to make a healthy level of return, but just the level of return isn't the only driver in this fund. It's also looking for positive social outcomes. So we're trying to find assets that are both healthy from a financial perspective or have a good expected rate of return, but also contribute to positive social outcomes. And those can be quite broad in what they are and how we define them. And as we've noted here, I think there's no surprises what we got here. Real estate in London, so supplying housing for people in London. Infrastructure, what are the things that London needs to continue to be a prosperous global city? Digital infrastructure, solar energy, rail networks, electric vehicles. The growth capital piece is something that we do have in the mandate, but frankly, it's a relatively small part of the focus. It's not something that we are focused on. The largest part of the portfolio is focused on real estate. Infrastructure being the second largest, and that growth capital piece is much smaller. One of the first investments was called Door. It's a large PRS housing investment. 4,000 homes under management, and probably the most well-known one is what they would call the East Village. It's the former Olympic Village in East London. There's also the Elephant and Castle development, which some of you may be more familiar with. In simple terms, it's a very large institutional portfolio of housing that is available on a long-term basis for rental to tenants, and these sorts of, and we're not alone in doing this. The reason I very much like this asset. I own a house now, but I rented in London for a very long time. Some of the challenges of dealing with private landlords was quite challenging when it wasn't quite so stable. This investment portfolio, the way it's managed, seeks to address many of those challenges: longer-term contracts, stability for families that they're not going to get essentially get kicked out of their house because the landlord wants to sell the house. There's long-term stability for families. The rents are all structured in a sensible way. The maintenance is done on a very centralised, controlled basis, so tenants don't have the challenges of the boiler not working in winter. All of that good stuff. So it's a from a PSO or responsible investment perspective, it's an asset I do significantly like. Oh, no, it's on my last slide. So very quickly. Market outlook, I'm not going to say that this volatility that we're experiencing is going to subside anytime soon. I think, unfortunately, the challenges we face globally, and that's certainly in the UK, there is no quick fix. This is going to take a little while to work through the system, and by that I mean quarters and years. Having said that, you have a diverse portfolio with global exposures, and we and the LPFA are very focused on managing through that long term, thinking about downside risks, really challenging ourselves on what are the things that we invest for and what are the cases where it could go wrong, and how do we build a resilient portfolio that is able to deliver the outcomes we're looking for. So long-term capital gain to pay pensions in the future, strong liquidity position, and cash essentially to pay pensions today. We made a public commitment to net zero around a similar time as the LPFA. So we made our commitment in November 21, and we are committing as well to net zero by 2050. Ours is subtly different as we're an asset manager, not an asset owner, but fundamentally we're pushing towards the same goals, and we are very aligned on that perspective. As I've noted here, the LPFA made the same commitment. I would say, the fund is strongly positioned for the future. That as of today, I look at the portfolio. I like the portfolios that we have for all the LPFA, but for all our clients. I will leave it there and hand over to the next speaker, Joe.
Good morning, everyone. It's a pleasure to be here again. It doesn't feel like a year since I was here last. I think I've aged 10 years for reasons which will become apparent as I run through the year that we've had in LPPA. Just to give you a flavour of what I intend to cover, then I'm going to talk about who we are, what we do. I'm going to talk about Project PACE, which is our flagship programme to replace our core administration IT system. And that will link into the performance because you will see some of the consequences of doing something that big in terms of our ability to keep our service at the levels it has been. I'll also talk to you about member communications, and then I will look forward. As a good friend of mine once said, never look backwards unless that's the direction you wish to travel. So we will be looking forwards as well to the more exciting things. I'm going to start this morning with a short video, which you can also find on our website, which articulates what we do as LPPA far more eloquently than I could. So if we could play the video, please.
Getting to know LPPA. When you're working hard for your community, it's good to know that your pension's ticking along nicely. And although there may be periods when you don't pay it much attention, there will also be times when you want to ask questions, check your benefits, and make 1 or 2 adjustments. That's where we come in. At LPPA, we take care of those everyday details, from setting up your pension and adding in your beneficiaries to estimating your benefits and helping you get ready for retirement. Whether you work for a local authority, police, fire service, or a different employer altogether, we're here to make sure everything runs smoothly. The good news is that when it comes to pensions, we're something of an expert. We support members from all different backgrounds and careers right across the country, from London to Lancaster and Bedford to Blackburn. Every day, we do our best to make the pension process simple, straightforward, and super efficient. And we work with thousands of employers from across the country to provide a friendly, stress-free service for members like you. As well as being forward-thinking and committed to excellence, we go out of our way to do the right thing and work together to get the best possible results. These sentiments inspire us to constantly raise the bar, improve our service, and come up with new ways to make your life easier. The secret of our success is that we put you at the heart of everything we do. We listen carefully to your feedback, respond quickly to your inquiries, and even try to walk in your shoes. It means you can rely on us from the minute you join your pension scheme to the day you decide to take your hard-earned cash, and for every moment that life brings in between. If you ever have any queries along the way, our friendly team of experts are on hand to help. No question is too big or too small, and while we're taking care of you, we'll leave you, the heroes of our society, to protect and support our towns, cities, and communities. To find out more about us, visit our website, lppapensions.co.uk.
Thank you. So a little bit more about our role. So we provide pensions administration services to LPFA, and also we have 17 other clients across local government, police and fire. And maybe something that you do know, we are jointly owned by LPFA and Lancashire. We cover all aspects of pensions administration across those life events that you go through from the day you join the scheme to the day that you retire and onwards. We do have a help desk. It's manned by about 30 people who will take calls and offer online support. We do member engagement and communications. I'm going to talk more about that a little bit later. And the online portal that you've heard so much about, Pension Point, I hope that many of you are already registered. It's a different portal than the one we had before we undertook Project PACE, and I'll talk a little bit more about that. That's the place where you can log on, you can change your details, you can update your beneficiaries. You'll also find all the documents that we produce on an annual basis in there, like your P60s or annual benefit statements. And we also work with all employers in terms of engaging them and providing training for them as well. I wanted to spend quite a little bit of time today talking about Project PACE. So, as I said, Project PACE is our big flagship program to replace our core administration system, so absolutely critical. It's a significant project for us to undertake something this massive. It really is huge. So this involves moving all our clients and all the data from one IT system to another. That involves over 600,000 members and their records. There are terabytes of data to move. The first phase of the project, we deliberately didn't go big bang, included LPFA. LPFA went live on the new system at the end of February. Where we are currently is we're halfway through. So we have half our clients moved over. The other half will go over in another 3 drops before the end of this calendar year. So I guess what's gone well, the first and most important thing is payroll. So the LPFA monthly payroll for pensions is close to £20 million. The first payroll from the new system ran perfectly. There were no issues whatsoever. So to take a payroll of that scale and move it over from one month to another being paid on different systems is quite a feat. And we're very proud that that worked, because that's the thing you really don't want to go wrong when you do anything like this. We've trained all our people. Registration for Pension Point is going well. We've got about 17,000 LPFA members registered so far. And this has been a year of firsts for us. So everything we've done this year so far on the new system is first for us. So your P60s were published into Pension Point. That's a first for us. Annual benefit statements were published into Pension Point and issued from our new system. So there's been lots of firsts for us throughout this year. And in the middle of all that, we also onboarded a new client. So the London Borough of Hammersmith and Fulham joined us in January. That's a benefit for all existing clients as it spreads our kind of fixed costs across a wider base, making a better value for money service. Inevitably, with something of this size, there are always things that don't go so well, no matter how well you plan. We knew it would be bumpy, given the timescales we implemented this over. I think it's fair to say it's been more bumpy than we expected it to be. That did impact on the performance, which I will touch on in a minute, and led to a significant increase in calls to the help desk, which also adversely impacted the performance in the help desk. So lots of learnings as we go into phase 2. So in terms of performance, nice pretty graph, what does it really mean? So what that graph is showing is for each month that's along the bottom, it's showing you the percentage of casework that we did within the contractual service level agreements that we have with the fund. So what you can see, and this covers all types of casework from a new joiner to a retirement across the board. So what you can see is up to and around kind of January, we were over that red dotted line, which is the 95% service level that we have. And then you can start to see the impact of PACE from February through to June. It's still not quite at that 95% line yet, and we've got phase 2, which will have an impact as well. But we will get back to that line and above that line. And we also kind of measure things slightly differently, so I'm not going to go into the detail of that today. But if anyone wants more detail, you can ask me outside. So that's the impact of PACE, that drop in that graph. If I go onto the help desk, you see it's more stark. What you can see towards the right-hand side of that graph is how massively the calls into the help desk increased as we went through implementing PACE. The primary reason for that was registration with Pension Point. For any of you that have registered, and I've registered with it, there's more security. Now, more security can be a good thing, but it can also be a bad thing. It can make your experience quite clunky. So the portal has something called two-factor authentication, which you'll be familiar with if you're using banking apps and those kinds of things. But it sends you a code, and it sends you a code when you register, and it also sends you a code every time you log in. So if you're trying to register and then log in, you were getting 2 codes quite close together, and I think some people found it quite confusing. So we're trying to simplify that for phase 2. We also had a new client, and when you get a new client, that drives kind of volume into the help desk as well. So we really struggled to cope with that massive spike in calls through the early months of this year. And the service wasn't where we would like it to be. Wait times went up to around 19 minutes at certain points in the year. So you can see that from the blue line. The blue line on that graph is showing you is the average wait time that you would wait for someone to answer a call. What I'm happy to say is that from the beginning of June this year, that was back below our targeted 4-minute average wait time and has remained there to this day. So as I say, it's been bumpy, it's getting better. I'm also going to talk to you about member communications. So I'll just touch on some of the things that we've done there. I played a video at the start. That's on our website along with some other videos. So please do go onto the website, watch some of the videos. We try and explain things in a really non-jargony kind of way. And give us your feedback. Feedback is really welcome. We've also recently started to move towards issuing some of the newsletters by email, making them a little bit more interactive. The last one had a quiz on it, if anybody did the quiz. I'm happy to say I got full marks, but I think I'd be fired if I didn't. And we also have a consideration given to the fact that we don't want to be digitally, we don't want digital exclusion. So we recognise that not everybody wants communications electronically. So we still do have a lot of things that go out in the post. That's obviously according to whatever preferences you set and can change. We do email communication for those of you that give us an email and opt into emails. You will have seen some through the first stage of PACE, encouraging you to sign up to Pension Point, I hope. We do training with employers as well, so that they can help the active members. And we've just recently launched some member research panels where we're encouraging members to take part in some member panels to give us feedback on different things before we launch them more widely. So lots going on in that member communication space, and as I'm sure you can appreciate, in a year where we do something as huge as Project PACE, then comms are really critical. So I'm going to just finish kind of by looking forward. So we've made a huge investment in this new core administration system, and it's important that we leverage that to improve the service going forward. So it comes with lots of additional functionality that we can turn on, and we will over the next few months. So it will do things like track if you have a case, it will track, you'll be able to go online and track where your case is without ringing the help desk to find out where it is. We'll also subsequently then move to ability where you can actually retire online, which might sound a bit scary, but actually it's very well done. Again, reducing the reliance on the administrators that we've got and allowing you to do more yourself. And we will also link the new administration system into our help desk system, so it does the clever things that your banks and things will do, where it recognises your telephone number and pops up your record to the people at the help desk, so they've got all your details the minute they start talking to you. And I referred to security earlier. Security is important, so that we're looking at ways to improve the identity verification on the application itself. So we'll move to sort of facial recognition and those kinds of things that you will be familiar with on your phone these days using your banking apps. So lots more to come. This is the beginning of the journey, not the end. And just generally in the pension space, there's a huge amount going on in the regulatory world. The pensions regulators introducing a single code of practice. There are a number of equal treatment cases that are going to require work. Some of you, I'm sure, have heard of McLeod. There's also a case around Goodwin. So there will be more work in that space. But the only one I wanted to kind of highlight for you today is a little bit about around the pensions dashboard, which you may have heard something about. A few years ago, you may remember that some of the banks worked together to make it easier for you to find orphan bank accounts. This is kind of a similar concept, but it's around pensions. So every administrator will give their details to an integrated provider who is then going to publish those details when you log into the dashboard. So essentially you'll put in things like your name, your date of birth, your national insurance number, and it will come back to you and tell you, from all the information it's gathered from all the administrators across the country, what pensions it's got on record for you. So it's a really good idea. There's a huge amount of work that's going to go on in the next couple of years to make that happen. So what's the timeline? The timeline is September 2024 for public sector pension schemes to go live on the dashboard. But there are a series of staging dates. So what does that mean for us? Well, there's a huge amount of work to prep for it, but also what we expect is that the government's going to go big on advertising and pushing the dashboard. So we'll start to see calls as soon as that activity starts, even though our staging date is September 24. So hopefully that kind of gives you a very quick flavour of dashboard. And like I say, there's lots going on. Just finally, it would be remiss of me not to mention kind of cost of living, given everything that's going on. We expect that to have an impact on our business. You know, we're already starting to see more people opt out of the scheme. People have to make tough choices. Some of you will be aware that LGPS scheme has a 50-50 option where you can take. We're seeing more activity around the website of people looking at that being an option to maybe reduce contributions. And we're seeing more activity in things like transfers where people are potentially transferring money out to draw down on it sooner than they may otherwise have done. So we're not immune, I guess, in the admin business from the cost of living crisis. I will be around at lunch if anybody wants to find me. I'm really not scary. And we're going to take a 20-minute coffee break now. So if you could be back here in 20 minutes, I make it about 20 past, so we can be back here for about 22. That would be excellent. Thank you.
It's good to see you all back for the final couple of sessions this morning. So the next session is me taking you through 15 or 20 minutes on where LPFA fits into wider society, and then we'll have a period of time for questions and answers afterwards, which will be moderated by the chairman, by John. Some of you have sent in questions already. Some people in the coffee break have put some questions forward, and we will have some roving microphones if you want to ask some questions as well. So please do take the opportunity. So this final presentation piece is, again, in response to your feedback that you wanted to know a little bit more about what we're doing more widely in connection with the pension fund, but in wider society. So pensions are this interesting beast. A lot of people think, oh, I'm not sure what it is. Is it just a pot of money? Is it something you do like a bank account, you get paid at the end? What this session will hopefully do is illustrate what happens to your money and how it does more than just pay pensions at the end of the day. So there's three things that I want to touch on. John alluded to this in his opening remarks at the beginning of the session. We do try and provide our members with some certainty in retirement. Secondly, we're investing directly into the UK's future, into infrastructure, real estate, and renewable energy, and Richard touched on some of those areas in his investment piece earlier. And finally, the third area for this session is we are trying to influence and possibly drive some change in company behaviours. So let's go back to the fund. 7.6 billion, a couple of days ago, 7.6 billion, 31st of March. So again, some of those messages about financial strength still is that the dog liking 7.6? Yeah, good. As long as everybody's on board for the 7.6, including the guide dog, we're in a good place. 7.6 billion, nearly 94,000 members. What the context is that all you guys in the room and us who are members of the fund, we're part of a bigger community of millions of people who are pension fund members. Our 7.6 billion is quite a big scheme. I think in the UK, we are the 64th biggest pension scheme in the UK. But that is dwarfed by the rest of the local government pension scheme, which is currently about £340 billion. And in turn, that is dwarfed by the rest of the UK pension system, so all the private sector schemes, all the schemes you hear about in the news, and that comes in somewhere north of, but do you know what? I don't actually have the figure. I don't know the figure, but we are a big fund as part of a big scheme in part of a bigger system, and you're all pension members contributing to that. The OECD reckons that across the world, there are getting on for 5 billion pension scheme members. And if you think of the good that 5 billion people could do with their money, that's something to try and get your head around in terms of what you do and how we invest and look after your money. So how do we invest that money? This diagram has hopefully makes some sort of sense. It's quite a simplistic diagram about money in and money out. The 153 million that I mentioned earlier in contributions, 100 million from employers and 50 million from employees, that gets invested in some of the asset classes on the right-hand side of your slide. That income that comes from those investments, plus the contributions, as I said earlier, go towards paying pensions. There are 3 asset classes, as we call them, in bold on the right, and those are the areas that we're just going to touch on for a second next. Before just getting into some of that detail, just to revisit some of those messages about certainty in retirement, because that's been a theme you will have picked up upon today. Some of these organisations you see on the left have surveyed pension fund members asking, what do you worry about in terms of retirement? And you'll see things flowing from having enough money, cost of living, all the way down to boredom, loss of identity, and some of those more social impacts you have. Fear of running out of money was the top one by a considerable distance. So LPFA can't make a difference on some of these categories, but we can talk about the first 2 in a little bit more detail. So certainty in retirement, a major benefit of LGPS, the bigger local government scheme, is that you are in a defined benefit scheme, not a private sector occupational defined benefit scheme, as John and Richard alluded to earlier, being in the press, but a public service defined benefit scheme. So you know what you will get when you retire. The pension that we provide is guaranteed, and every year you build up the equivalent of 1/49th of your salary. The next year's amounts are then added to that amount and updated to reflect any cost of living increases. And then when you retire, that's the amount you get as your annual pension. This should make your planning and your retirement reduce more of the concerns that you might have on the way in. This isn't necessarily the case with the wider occupational DB schemes or indeed DC schemes. The second area, of course, and Richard spent quite a bit of time on inflation. There is some linkage in LGPS to inflation, but as the cost of living increases, so should your pension. And finally, Jo touched on it at the end of her presentation, but if colleagues do find they have some difficulty and they are considering leaving, the LGPS scheme is relatively unique in allowing people to take a 50% cut in their contribution with a proportionate 50% reduction in pension, but that means you don't lose out on the ancillary benefits and you don't leave the scheme. So there are some measures in place already to help in times of uncertainty. So we talked about how much we pay out. Jo's figures were more accurate than mine, more up to date. So we're paying out approximately £20 million per month, or 240, nearly £250 million a year in pensions to LPFA colleagues. In terms of impact, what we pay out is probably the most visible and the most obvious way. But leaving aside pensioners for a second, if we turn to where they live or where they come from, this slide might be of interest to you because although we are the London Pensions Fund, you can see that many, many of our retired members live outside of London and the South East. I don't know if anybody's travelled very far. Has anybody travelled further than London and South East today to get here? 1, 2, 3, 4. Guide dogs from London, is it? Yeah, okay. But we have members throughout the UK, and part of this presentation is around the wider impact than just London and the southeast of England. And the fact that when you obviously draw a pension, you are contributing to that local economy. And when we're investing, we're also making a contribution to local and national economies. How do we invest? Let's pick on two other asset classes that we've sort of spoken a little bit about today, but maybe of interest to you in terms of what we're doing with your money. And those are infrastructure and real estate. So infrastructure, you'll see the headline numbers on there. It's about 10% of the pension scheme fund assets, and it's invested by LPPI. We mentioned GLIL earlier, and the fact that that's a collaborative piece between a number of pension schemes. And the message from this slide is that we, being a large scheme, but part of a larger organisation, larger pension system, can do more good when we have critical mass and we have more people investing. So we can do more than we can on our own by being invested in things like GLIL and make better contribution. The real estate fund is around 9% of the fund, again with the majority being invested by Richard and his colleagues, although some of it goes via the London Fund. So, what areas in terms of real assets might you recognise? So we do some investments in wind. You'll see on the slide quite a few geographical regions where we have wind farms. You'll see that we also have, it's predominantly UK, but we do have overseas investments in Portugal, Ireland, and Finland. But one of those, the bottom one in bold, the Hornsea one, just to give you a little bit more context about that investment, it's about 400 square metres in size, and that's about 64,000 football pitches, if people are familiar with the size of a football pitch. It's off Yorkshire coast. There are 174 turbines. One turbine produces energy for one home for 24 hours. So in total, that investment can generate power for over 200,000 homes. And you, as a member of LPFA, are investing in this project. So not only is Hornsea 1 up and running as part of a larger development, but Hornsea 2 also went online in September, and Hornsea 3, another variation on this, is planned for the future. So some of these investments are being incrementally built upon, but you own some of these investments, and you are making a difference in terms of renewable assets and also investment into UK energy and security. So what about solar power? So again, there's a list and a map of areas in the UK where we're investing in solar. Together, all these assets that we hold can generate electricity to power over 600,000 homes in the UK. So again, I'm just trying to reinforce that the reach or the impact you have isn't just around London and the southeast of England. So apart from solar and wind, what other things do we think of in terms of infrastructure? And these would include things like Anglia Water, East Anglia Rail, South West Rail. Anybody come on South West Rail today? Yeah, please don't beat me up about how bad the service is. The first year I did one of these in 2018, I mentioned South West Rail and I asked for questions at the end and someone asked me to fix the railway. I think you've got a fabulous team looking after you, but we can't fix the railway, so please don't go there. Anglia Water is a brilliant example of some of the things we're doing on the corporate governance side, but also in terms of them as an asset we hold in, and they do manage something like 50,000 miles of sewers, and they do produce a lot of fresh water for multiple homes throughout the region. But one example that might also interest you is we own an organisation called Forth Ports. And Forth Ports has actually got 8 ports. It looks after, it moves something like 40 million tonnes of cargo a year. It's got over 1,000 employees. And more importantly, and certainly from a renewables or a climate change impact, it does a lot of work decommissioning North Sea oil infrastructure, oil rigs, organisations, pieces like that. And this hopefully gives you an idea via the GLIL offering that we have is the breadth of things that you are invested in and also make a difference, as well as producing a return for us to add to those contributions to continue paying your pensions. So that's where we're trying to get on the link here. Just moving on into real estate. There are two sides to our real estate investments. Basically, the first one is non-London investments. We have about 50 direct investments as well as more investments through other funds. Things that you're invested in include shopping centres in Bristol, shopping centres in Weston-super-Mare, Ashford, Leeds, Farnborough, business parks and office space in Windsor, Daventry, Dunstable, Wolverhampton. And you also have got distribution centres in Wakefield, hotels in London, hotels in Manchester. So we're investing in places where people go, where they work, and where they live. It's a UK-wide piece. The cluster you can see in green is our London investments, and they are largely via the London Fund that Richard touched on earlier. The London Fund is this vehicle that we set up a couple of years ago, as I mentioned earlier, which is a collaborative piece of work to invest in London across a number of areas, but to do so collaboratively, get a return, but also do some good in wider London. And you'll see on here, the London Fund is invested with New Capital to redevelop things like Shepherd's Bush Market. So those of you who are Londoners will know Shepherd's Bush Market. That is being redeveloped via the London Fund. Not only is affordable housing going in there, but there'll be also space for technology companies and a commitment to support the traders so they can keep some of the identity around Shepherd's Bush whilst this development goes on. So I think we should be really proud that some of the things we invest in via the London Fund are doing some good, but continue to generate returns to pay the pensions. So, final session in this presentation, it's about public equities or stocks and shares, as we mentioned before. We're about nearly half of the fund is in these. And as Richard mentioned earlier, we have this vehicle called the Global Equities Fund. And the clue's in the title, it's just not UK, it's a global fund for stocks and shares. You might recognize some of the names on the screen. Some of them are very popular, very well-known brands that you invest in. So you'll recognize some of these. Being a member of LPFA, you essentially own part of these businesses. And on your behalf, and on behalf of the LPFA board, Richard and his colleagues at the investment business attend company meetings, they vote on company resolutions, they lobby companies to change, to improve their behaviour or to make a difference going forward and to ensure they're doing the right things. There is an awful lot of engagement that goes via the investment team about your ownership of parts of these businesses. Changing company behaviour, it's not the main thing we do. We're here to pay pensions, but it's an important part of the oversight and how we manage our assets and how our investment company runs our assets for us. So LPPI will speak with company boards and their investor relation teams via email, face-to-face, video conferencing, and importantly, will vote at annual general meetings. Remember that we're invested in the Global Equities Fund in over 200 companies, and each one has to have an annual general meeting at which various resolutions or various opportunities to feedback are presented. So you can see how much time engagement can take up, and the fact that LPPI do a lot of this for us, but they also use an external company called Robeco, who are on the left of your diagram, to support them in some of that work. We also mentioned earlier the Local Authority Pension Fund Forum, and they also do a lot of work lobbying, voting on behalf of the wider LGPS community. So again, coming back to the theme about we're a big fund, but when we collaborate with other people, we can make more of a difference and have a louder voice heard in some of these organisations. It also, I hope, chimes with colleagues around our strategic ambition is to be collaborative, and we do like collaborating with other people to get messages across. So, a snapshot of activity from the last year. in some of these areas. So the LPPI team sent 125 emails, they held 133 conference calls, they wrote 37 open letters to company boards, and they voted 399 times on over 4,400 of these resolutions at annual general meetings. I think you'd agree it's not unsubstantial body of work the team does in addition to investing your money and generating returns that they do so well. Some of those resolutions relate to company behaviour, but they vary across the topics of environmental impact, living wage, net zero plans, human rights, cybersecurity, healthy foods and obesity, CEO pay, risk in the banking sector. They're across multiple areas of corporate governance and responsible investment. And LPPI do a fantastic job at keeping on top of this through their engagement activities, as I just outlined. So, to conclude, what next for us? So hopefully today has given you a snapshot of how well we've done last year, what we've done in terms of listening to your feedback, of trying to give you a flavour of the administration and the investment progress that's been made. The numbers are very positive. The activity has been very positive, but hopefully we're now trying to share more of how we do things and why we do things and why it's important to connect with you and what your money does. We have more to do, of course, and we need to continue to improve on some of that responsible investment, some of that communication work, some of that transparency, and certainly for those of you who are interested, when we publish our net zero climate action plan in the next 6 weeks, you will see some really good detail on what we're going to be doing between now and 2030 and 2050, and that should give you some insights into where the board is. The new RI manager that starts next week will hopefully help with the communications on that as well. So thank you for listening. I hope that has tried to put you as the member, us as the pension fund, our colleagues on the administration and investment business, investing your money and doing some wider good. And I hope you find it interesting. Thank you very much.
Thank you, Robert. We're now going to take questions from the audience. But before we start, can I please just remind you once again, if you have any questions about your personal pension circumstances or that relate to your pension specifically, those should be directed to the colleagues at the LPPA help desk in the foyer. Virtual attendees will be directed to the appropriate point of contact through the chat box. We'll take questions here from the audience in the South Bank Centre, but a range of questions have already been submitted in advance, both in person and by virtual attendees, as part of the registration process, and so we'll put some of those to the panel as well. We'll also be responding to some questions that have been asked by our virtual attendees during the presentation so far this morning. For those in the audience this morning here today, if you do have a question, can I ask you please to raise your hand, and we'll direct our colleagues towards you with a microphone to make sure that everybody can hear the question. So if when you raise your hand, somebody will come to you in a second. Before I open it up to the audience, let me just start with a question that came in through registration, which I hope we've addressed, but I'm conscious is at the forefront of everybody's minds. Clearly, the current economic climate was a clear theme in the advanced question. So let me just start with a question which I'll take myself, which is my pension safe and how will it keep up with inflation? I hope we've demonstrated during the course of the presentations today that your pension is safe. It is, I have to say, remarkable and a huge credit to LPPI that with all of the volatility that's been going on, the value of the pension fund has stayed pretty static since the 31st of March. I assure you there aren't many pension funds that can say that at the moment. In terms of inflation, the rules of the LGPS are clear. They say that pensions will be uprated from April next year in line with the increase in the Consumer Price Index as at the end of September. So when we get to the end of the month tomorrow, the government will eventually publish what the increase in the CPI, the Consumer Prices Index, was, and the rules say that that is what pensions in payment will be increased by with effect from April next year. So I hope that once again reassures people about the safety and inflation linkage of their pension, but obviously happy to take more questions as we go forward. I've got some more questions that have been asked in advance, but I'd like to open it up to the audience. If, as I say, you could please raise your hand, we will direct somebody towards you with a microphone. I don't know if somebody can
I've got a
actually
mic.
bring the lights down a little bit, because I'm finding it very difficult to see the audience.
My question is, you mentioned there are pensioners already all over the UK, even though this is the London Fund. What happens to your pension if on retirement you choose to move abroad?
Joe.
In terms of the scheme rules, it's no different. So maybe you think that certain state benefits, for example, freeze when you move abroad. That's not what happens with the LGPS pension. And we have mechanisms and lots of pensioners who live abroad who we pay on a regular basis every month.
Lady there.
Thank you. I did submit this in advance, but since then more information has emerged, so this is a slightly more detailed question. My name is Lisa Rebecca Warren. I work for a university in London. It's a university which trains nurses for the NHS. Do bear that in mind when I read this question. We as members appreciate the LPFA action on climate change and minimising our exposure to fossil fuels and potentially stranded assets. I can go further and say not just minimising it, but ruling it out altogether. But there are other aspects to an ethical portfolio. I can find no information in your responsible investment policy about avoiding specific investments that are known to be damaging. The objective of your members is to enjoy a comfortable and healthy retirement, and investing in deadly products such as tobacco and armaments is not conducive to the objective. Have you considered your position on such investments? And I can add further, once we got the information about this, about the forum, it's included the point about the transparency dashboard, so I was able to look at it and find that out of those the roughly 50% of the portfolio, which is in equities, 0.35% is in British American Tobacco, 0.3% is in Philip Morris. Those are just the ones that caught my attention. That comes to something like, I did this in my head, but it's something like 20-something million pounds. I mentioned at the beginning, my employer is a university which trains nurses for the NHS. I think possibly we should be concerned that the university is putting investments into tobacco. So I'd like to see how you respond to that. Thank you very much.
Oh, thank you very much for that, and great to see you here, and the work you're doing training nurses is fantastic, and another example of the diversity of members and employees we have throughout the scheme, which is great. If I may, that was quite a lot of content in the question, but a couple of themes that I picked up on, which I'm happy to answer at the moment, is if you look at how we consider our responsible investment, we spend a lot of time, and we have done certainly in my tenure, looking at what our policy says, what we can do and what we don't want to do, and then implementing that in a transparent way. So over the years, our RI and ESG policies have evolved, but we have chosen to invest more time in our climate change and our fossil fuels activity than the wider RI policy. The wider RI policy does not currently have exclusions, and we have debated long and hard about excluding certain things, with the exception of the climate change elements, where we will not put more money into extractive fossil fuels. So as a board, and organisationally, we do challenge ourselves every year about our forthcoming improvements to our RI. And that activity is one of the major strategic themes for next year. So I think you will see some change in the current RI policy, but we do review it and monitor it every year. The second point you raised is about specific holdings. And I think from last year's feedback from colleagues here and the member survey, you absolutely said you wanted to understand more about our holdings and what we do. And we've responded to that by putting this Tumalo vehicle onto the website and setting out where we put our holdings. Richard might want to pick up on how the Global Equities Fund actually operates, but we look across a worldwide universe. We look across assets that will benefit the long-term sustainability and return-seeking assets for the fund. And as a consequence, the publication of this information we think is healthy and it's a good thing, But yes, there are some things in there that may be less tolerable to colleagues than others. Richard, do you want to just pick up on how the GEF works and how we look at those kind of things?
So within the global equity portfolio, you need to remember that it's a pooled vehicle. So it's not just the LPFA's assets in that vehicle. So we manage those assets for the LPFA plus our other pooling clients, other LGPS schemes. So if we make a change in that vehicle, it doesn't just affect the LPFA, it affects all our other clients who are LGPS schemes also. The structure, the specific structure of the fund, around a little bit more than half is managed internally. So these are our internal team selecting stocks. The two names you mentioned are not owned by portfolio managers from within LPPI. They are within the external portfolio. And the external portfolio is around about 45% of the capital split across 5 managers at this point in time. They're picked for their pedigree, track record, skill set for selecting stocks in the strategy we ask them to pursue, and we put in place a mandate with them. But as Robert noted, our philosophy is not to have hard exclusions in too many places. We do have, as you say, around the climate change area, we do have some specific exclusions that we have in place, and we do debate this back and forth about where do you put exclusions in place. But the one thing I would note is certainly we have that fiduciary responsibility to pay pensions and to maintain the financial the responsibility to the employers in terms of that financial return element of the scheme. So whilst we can, and as per the LGPS regs, we can pay attention, and the schemes can pay attention to other factors, it mustn't, and I forget the exact wording, it can't have a materially negative impact on the financial position, or words to that fact. I've got that wording slightly wrong. What it's saying is you can take into account non-financial factors, but they can't have a material negative impact on the expected return or risk profile. So as you say, where we are moving in that direction, we are paying attention to these things, but specific exclusions are challenging when lined up against the specific LGPS regulations from that perspective.
Thank you, Richard. I've got some more questions that have come in before. Is there any other question from the floor? Oh, gentleman here, please.
My name's Stephen Duckworth. Thank you, Richard, for quite a clear investment presentation earlier. Could you be equally clear and understandable on a couple of points? Firstly, with the chaos in the markets in the last 24 hours, a lot of pension schemes, particularly corporate ones, have had to find a lot of cash very quickly. And I believe some public sector schemes probably have had to as well. Why has the LPFA managed to avoid that? You did state it and avoided it, but you didn't explain how and why. And secondly, on a positive note, if interest rates stay fairly high, as they seem to be moving, after a very long period of low interest rates, isn't this going to significantly help on balance the health of our scheme? Thank you.
So we'll take the first one's relatively easy. The LPFA don't have an LDI, a liability-driven investment portfolio, so stay away from the jargon. The types of assets, the strategies that some private sector defined benefit schemes have pursued, which have caused some of the challenges. The short answer is the LPFA has no exposure to the investment strategies that have caused these challenges. And as I say, so whatever you're reading in the press about defined benefit pension schemes facing challenges or whatever words were being used, it's just not relevant to the LPFA because you just do not have exposure to those specific strategies and assets where the challenges have arisen. On the second point, the interest rate point, this is the one that, if I'm honest, is engaging significant amounts of my headspace and the team's headspace, and has done for a fair while now. And we keep challenging ourselves. What is the impact? What might the timeline be? Where might interest rates go? What might the impact be on the portfolio? The key point I'd make is that you ask yourself the question over what horizon, and where might we end up? I think there's no doubt that interest rates are going to be higher for the near term. What is that, 6 months? Is that 12 months? Is that a year? Sorry, I said 12 months, 18 months, 24, who knows? I've got my views. I think they probably will be reasonably high for a little while. And I think that will be sufficient to cause pretty significant economic pain, which will then lead central banks to start thinking a little bit more. And that should have an impact on inflation. But there is a very real scenario where we face some economic pain and inflation isn't tamed. And central banks will continue pressing forward. And then we enter into a world where interest rates are genuinely, as you note, we used to say lower for longer, higher for longer, and we enter into a world that is more inflationary, more higher short-dated rates, higher longer-term bond yields, and so essentially deglobalizing these types of factors. And and deglobalizing. And in that scenario, that will then start having a feedback loop on the pension scheme. Specifically, that will have some impact on asset valuations. But I think the critical point, which is you were driving at, is in terms of funding level, that's likely to be very positive, because discount rates for discounting back the future value of the liabilities will go up. And that, in terms of funding level, which is one of the metrics you look at for pension scheme health, should increase significantly, or will have a positive impact. But it will have an impact on the asset side as well. But that's more likely to be short-dated rather than long.
Thank you. I think there was I'm getting a number of questions from the front. I don't know if that's just because people wanted to sit at the front to ask questions. The gentleman there.
Hello. Good morning. Now, you see, my question is, as I say again, John Preston has explained that the payment of pensions in line with the inflation. And I asked the same, another scenario basis. So as the rate of interest goes upward, 2.259 and maybe 6% in May, so would the change will come in line with the interest rate of the Bank of England?
Okay, so I was just wanting to make sure I understood. So this is about the inflation linkage. Is that your question?
Yeah.
Yeah. So the way in which the pensions in payment will be increased is the government will announce what the increase in the consumer price index was over the year to 30th of September. So effectively over the year to tomorrow.
I see.
Once that index is announced, that is the rate by which pensions in payment will be increased with effect from April of next year. So I'm plucking a number out of thin air. If the increase in the CPI over the year to 30 September is, let's say, 8%, I'm not saying it is, I'm just picking a number, then pensions in payment will increase by 8% with effect from April of next year. That's written into the LGPS rules, and therefore that's what will happen.
Can I ask one more, please?
Yes.
Yeah. If somebody moves out of UK, say for a number of years.
If you move out of the UK, it has no impact on that at all.
So the payment of pension will be moved wherever the man or they move
As
to.
I think Joe said earlier, if somebody lives outside the UK, we will simply pay their pension to them to wherever they happen to be.
Yeah.
And we have systems in place to make sure we can do that.
Thank you very much.
Gentleman there.
Oh, sorry.
Okay. We'll do this one, then we'll do the next one. I'm sorry. It's quite difficult to see the audience at the back. My apologies.
Thank you, John Crawford, pensioner. I noticed that you still have fixed income items in your list, Robert. Aren't they bonds that is in the crisis at the moment rescued by the Bank of England? Yes.
Do you want me to take that one? Let me take that one. So, factually, what you said is absolutely correct. That the challenge is very much in fixed income markets, bonds. It's a very broad church of what that banner title can mean, though. So we have a fixed income investment vehicle. It's as you can see from the asset allocation, it's relatively small. The purpose in the portfolio is to provide what we would call liquidity in the portfolio. So the assets in there are not the long-dated bonds that have been getting swung, let's just say, moved around significantly. But the instruments in there are much more shorter dated. So by that I mean there are bonds in there, but they're shorter dated. So 2, 3, 4 year, what we would call duration, but the length of loan, let's say, or bond. So, but again, it's not the purpose isn't to invest in long-dated bonds as where the challenges have been. It's the purpose is, as I say, to provide an alternative source of liquid assets that aren't cash. Yeah. If that makes sense.
What about the pooling fund? Is that invested all around the world in other economies,
yes,
as well as UK? So, what percentage is outside of the UK?
Short answer, significant. Yeah. A slightly more nuanced answer would be, it depends by asset class. It varies quite significantly by asset class. So, for example, within global equities, the bulk of the capital is outside the UK.
Yes.
I think 80, probably 85% at least, maybe 90. But within, say, real estate and infrastructure, those are biased towards the UK.
Yeah.
And I can, as an aside point, I can give a more detailed explanation as an aside if that's of interest as to why.
What did you mean by diversified strategies?
Yeah, so diversified strategies are strategies that we would put in the portfolio that are, I'll try and put this in the right terminology for this audience, aren't depending on equity markets or bond markets going up to generate some positive return. So these are strategies that are subtly different to traditional bond and equity investments.
Yeah.
So for example, one of the assets we've held in there has been reinsurance strategy. So that's essentially providing catastrophe insurance to insurance companies, essentially, who then provide ongoing insurance to corporates and individuals.
Yes. Do you invest in airports abroad as well? That's another diversified.
We own a small amount of airports in the portfolio. I'm now going to have to, the main element we have, the main exposure is UK based. There's possibly in one part of the infrastructure portfolio some exposure to international overseas airports. It's going to be small though. It's going to be very small.
Thank you very much.
Thank you. So other questions? Fanula, I think you've got, oh, it's over there, is it? So please, yes, thank you. Yes, I can.
Oh, right, okay. My name's Nick Steiner. Looking forward on renewables, where the return may be a little way ahead, where are you on the hydrogen, battery storage and tidal developments? And if you have a look around the world, Germany and South Korea seem to be well ahead of this country, although we've got some very good companies in this country. So what's your views on that?
Okay, thank you. No, so if I've understood the question correctly, I think it's how are we investing in the green transition? How are we supporting that? I've used slightly different words, but and in terms of the development of the grid and energy sources that are going to move us from a fossil fuel past.
Fuel cells and
exactly.
electrolyzers.
So we're investing in that, and I suspect strongly we'll continue to invest in greater scale in the future. So we have invested in a battery storage, call it facility or business, within our infrastructure portfolio. We've backed it as a business there. It's something we're actively looking at. There's certainly, we haven't done anything in hydrogen yet, but certainly within infrastructure, for example, we have, there are assets we own, pipeline assets essentially, where clearly they could be used for piping of hydrogen and the retrofit of that. We've looked at some of those investment cases. As was in Robert's presentation, we already have significant wind assets in the portfolio. And it's clearly something we are very interested in, engaged in. And if you step back and if you think about, we have our net zero 2050 policy or commitment, the LPFA have that as well. The reality is a significant part of delivering that for the world is decarbonising the grid and energy sources. We intend to be a fully paid up member of the solution, not the problem, in terms of pushing that forward.
Thank you. I think there's somebody up there.
Thank you very much. Related questions. The first one, as a follow-up to the retirement abroad issue, is it possible to have one's pension income paid gross rather than net of tax? And the second question is on the retail investment in the portfolio. I noticed in the map that you showed, although you mentioned Leeds and Manchester, there seemed to be a huge gap north of that. And I wondered if that was a misrepresentation on the map or if there's a particular strategy that cuts out the northeast and everything further north. Thank you.
Yeah, I don't know the answer to the first question, but I'll take it away and come back. I'm sure we can find a way of getting you the answer if you leave details at the end.
Yeah, I mean, we will check this. I think the short answer, though, is that the rules as to whether you have compared gross or net are based on HMRC rules rather than our pension rules. And I think it is unusual to be able to pay the pension gross. But as Joe says, if you leave your details, we will look into it. But I'm afraid I wouldn't be hugely optimistic about that because of HMRC rules.
Yeah, it's John's question. So I think if I've understood the question correctly, you're saying, are we very biased to the south and not investing in further north than Manchester? I think was the question in terms of real estate. The answer is we have I was about to say global mandate, a full regional mandate, if that makes sense. We do, it's all in scope, but the types of assets we prefer, you tend to find in different parts of the country, and you have different return drivers of them. So there's absolutely not an exclusion on any region of the country. And remember that the other partner in LPPI, the other founding partner, or shareholder I should say, is Lancashire County Pension Scheme. So we have an office in Preston. We have another significant stakeholder group in the north of England. We look at investment cases all around the UK. And I think it's where we've seen more interesting assets. I think there was the retail sector got mentioned in the question. I think if I heard that correctly. I apologise, the acoustics of this room, I couldn't quite hear. But, as an example, retail isn't something we've been investing in for a fair while. We've been fairly concerned about the outlook for retail assets, and that's proved to be a good call. We are underweight retail assets. We have been investing in more distribution type assets, so logistics. And if you think about the location of some of those will tend to be at more major intersections and hubs. So some of those, you're going to find them around Birmingham, you're going to find them around Manchester, and some other places. So those will be the things that drive where we allocate, and then the expected returns on the assets. So, but not on we invest in this bit of the UK and not that bit of the UK. We have assets all around the UK.
Thank you. I think there's somebody up here.
Philip O'Halloran. The 50-50 option for members who are struggling sounds a good idea. But when the good times come back, ever the optimist, are people able to return to full membership? And is there any provision for them to buy back the 50% that they lost over a period of time? That's section one. Section two is looking at the green investment, particularly solar panel farms. Are you looking to ensure that good arable food production land isn't destroyed by waves of solar panels?
Thank you. So the answer to the first question is yes, and the answer to the second part of that, can you then top up or replace that lost pension, is yes as well. There is some very clear jargon-free guidance on the LGPS website about how you might do that, and all employers are very supportive of requests from members if they want to do that, so you can definitely do both those things with 50-50.
And on the second question, with every asset we underwrite, we look at it across a whole range of factors. It's one of, it absolutely isn't just viewed through a lens of, is this the maximum financial return for the risk that we're taking? So we as a firm, as LPPI, have a responsible investment policy, and we take those type of issues very seriously. In terms of using I think the question was about arable land, and is that to be taken out for investment in wind farms or whatever? Absolutely, we'll look at the environmental impact of these things. Every asset we look at in that area, there'll be an environmental impact study, and that's something we'll evaluate. So it's certainly considered as part of the process.
I'm going to take a couple of questions, if I may, from people on the virtual space to give them an opportunity. One question for Joe. Joe, can you advise what LPPA are doing to protect members from scams?
Yes, I can. There's lots of things that we're doing there. We're a member of an industry body and forum that collaborates to do that, and we've implemented, we're usually ahead of the curve in terms of implementing things. There's been lots of recent changes to the communications. I hope that you will see on the footer of our emails, and when we send you things, that you will see at the bottom lots of detail around why the communications we're sending to you is not a scam. They do increasingly get more sophisticated, so it's a never-ending journey. I think what we've also seen in the last couple of years is a lot more tighter regulation around pension transfer scams. So there are lots and lots of checks and balances that we have to do before we will allow a transfer out of the scheme. It's a lot tighter than it was a few years ago. Unfortunately, there are some stories that date back where people have transferred money out and lost everything, which are horrific. It's a lot harder for that to happen these days.
And Joe, just one more question that came in virtually. You mentioned the pension dashboard and the information that we're going to put on that. What checks and balances are in place to verify that information and keep it safe?
There's a few different ones, so I'll touch on three things. So first of all is the checks and balances on the numbers that we give to the dashboard. So the current design is that when we run kind of annual benefit statements, those kinds of things, those figures are given to the dashboard so that they're consistent with figures that you've seen. In terms of data transfer, then there's lots of discussions at the minute in terms of the design of the dashboard to make sure that data transfer will be absolutely secure. And then there's also conversations going on and consultations going on around the kind of matching that goes on when you log into the dashboard, because what we don't want to happen as an industry is that you put in some details, so maybe your name, date of birth, it does some kind of fuzzy partial matching and comes back with an NI number, so we've suddenly given a fraudster some more information than had originally. So there's lots of discussion going on to make sure that doesn't happen.
Going back to the audience.
Tunde Olusegun is my name.
Thank you.
Thank you. Tunde Olusegun is my name. In terms of the report that you give, thank you for that. In respect about the impact of the war with the Ukraine, I mean, it was so low, which is 0.1, as you mentioned. However, in terms of investing in some organizations that believe in sustainability and other things, if a company policy, maybe at AGM, which we have investments, changes their direction, do you pull out such investment totally, or do you report back to the AGM? One. The other part of it is in terms of real estate investment, maybe in building houses or renting a community. Does member have a direct benefit, or is it in terms of profit or earnings that you make from such investments? I mean that in case member apply for such estate, would they have to be given a preference or preferential treatment being a member of the scheme, or do you do with it directly without getting involved? Thank you.
So I think, forgive me, it's something, the audio is not great, so we're going to do something about that next year. But if I understood the questions, the second part of the question correctly, it was effectively, are we monitoring the investments once we've made them to make sure that companies continue to do the things that we think they're going to do? And secondly, whether members have any direct say in, say, how companies are voting and so forth, or whether we do that on our behalf. The short answer to the first part is yes. There's a huge amount of monitoring that goes on and what we call engagement with the companies. LPPI spend a huge amount of time engaging with the companies in which we invest and having conversations, not just to try and make sure that they are doing what they say they're going to do, but actually they are on a journey to improve what they're going to do. There are various measurements out there run by various organizations which look at the green credentials, the responsible investment credentials of companies. And that is something that LPPI spend a great deal of time looking at. In terms of direct involvement from members, no. We hold the assets and LPPI, as our investment manager, will vote those on our behalf. But they obviously do that by reference to the policies and strategies of the clients that they have in their fund. So I hope that...
and if I may, just to add some colour to that, if LPPI have engaged with somebody and they either change, as you suggested, or they do something different, or they don't change to some of the standards or criteria that Richard and the team have set on our behalf, then ultimately we will walk away from that investment. And it's important that colleagues know that we have in the past and in the future we will walk away from investments which do not meet LPFA's policies or LPPI's policies. So you should take that reassurance as part of that question.
Absolutely, thank you. Next, lady down there, please.
Hello. I'm wondering, as the law stands at the moment, with being very uncertain sort of financial times, is there any way that the government could raid the occupational pensions of local and central government? As the law stands at the moment, and also could they change the law?
Well, I mean, I suppose ultimately Parliament can do anything it chooses to do. So there is no, I can't give you an absolute guarantee that they can't change the law or change the regulations. What you're frankly then dealing with is a question of practical politics and whether the government would be prepared to introduce measures that would affect literally millions of people and their pensions. I can't promise you they won't do that. I very much hope and expect that they won't. But ultimately, the government can do anything it wants to do.
At the time of the financial crisis in 2008, that the IMF made conditions that Greeks had to, and I have a Greek friend who was retired, and their pensions, but I'm not sure if it was their state or their occupational pensions, were definitely reduced by 25%.
Yeah, that's more difficult in the UK because of the way in which the LGPS is set up. I mean, as I say, the government ultimately can pass any law that it can get through the House of Commons. I think it is extremely unlikely that something like that would happen in the current circumstances because the political implications would be huge. And I wouldn't want anybody to walk out of here thinking this is a major problem. But I can't give you a cast iron guarantee that something can't happen because government can, if it can get it through the House of Commons, do anything it wants to do. I don't think it's very likely, though.
Okay, thank you.
Very conscious of time, so can I have just one last question and then we will move on?
Thank you. My name's Alan Clyde. I was always been a finance man, former finance director. And I know that in July, CPI was 10.1%. In August, it dropped to 9.9. My left hand wants inflation to come down as quickly as possible. My right hand wants September CPI not to be lower than it was in August. Now, I'm going to work, Chairman, you suggested 8% as randomly. My fingers crossed it's 10. And the increase in CPI. But my question relates to figures that Robert quoted earlier, where the fund's income, and I take this was to the 31st of March 2022, 153 million, and payments to pensioners 224. Well, this year we had a 3% increase, so I'm taking the 224 to 230, and if I then apply 10% to it, it takes it up to 250. That's a £20 million increase in payments. You have reiterated and emphasised the fact that the fund is in a very strong position. Thank you very much for that. But globally, companies are not expected to be paying the dividends at the level they have in the last few years. So my question is, how is that £20 million increase going to be paid for? Will it be income generation, or do we face the prospect of having to sell some capital? And to finish off, will the fund balance be 7.6 million at the end of 31st of March 2023?
Oh, so you're asking the unfair questions last then, yeah?
Do you want to take that?
Oh, I'm happy to.
Yep.
Let me take
Richard,
that one,
please.
Yeah,
Well,
very
I say
happy
easy,
to.
that was a Freudian slip. I wouldn't say easy. I can answer that question, but it may not satisfy the question asker.
Indeed, yeah.
So the short answer is, you're absolutely right, there will be a change in the cash needs to pay benefits from the fund. That's, as you say, absolutely correct. It's something that we look at carefully, we monitor very closely. We've actually got one of the LPFA executive teams in the audience back there. I can see him. It's something he's all over as well. It's something that we look at very carefully. The short answer is the portfolio has a whole range of assets beyond listed stocks and shares. There's a range of them are income generating, and we're consistently looking at, on an ongoing basis, we look at what are the future cash needs of the scheme from a benefits payments point of view, as well as other things on a forward-looking basis, generally many years forward. The changes to those requirements are factored in, and then we're making essentially on an ongoing basis rebalancing decisions to reposition the portfolio in light of that. Clearly, the scheme has some cash at hand in terms of liquid assets. You have income being generated organically from the portfolio, and that does vary, as you say. But it's essentially just the machine just rebalances, because when we get through it each time, we look at the requirements, we reposition the portfolio. So there won't be I find it almost, I'm not going to say it's impossible, because that's a foolish thing to say, but it's almost impossible that the cash won't be available to pay, and the portfolio will organically adjust. And remembering that this is a defined benefit pension scheme, so over time, depending on what happens with future membership and all that, you always have to be thinking that at some point you are decaying the capital base down because the membership is falling. That's not a given, but that possibility is always there. And the cliche always says the end game for a pension scheme is to have $1 left or £1 left as you're paying the last member out. So I think there was a second question, wasn't there, as well?
Well, the second part of the question is it going to be 7.6 billion? You wouldn't expect us to give a guarantee one way or the other about that. But just to put this in context, without trying to surprise anybody, actually the crucial figure for us isn't the absolute value of the fund. The crucial figure is something Robert referred to, which is the funding level, which is the ratio of our assets to our liabilities, and to make sure that we have more assets than liabilities. And of course, it's not just assets that go up and down, it's liabilities that go up and down as well. And so, whilst I can't give you an absolute guarantee about what the asset value will be, I can give you an assurance that we spend an awful lot of time worrying about the funding level and making sure that we keep that under control to the extent we possibly can. Thank you, everybody, for the questions. I'm conscious we've overrun slightly. All of the panel members will be here over lunch, so if anybody does have any questions they haven't had an opportunity to ask, obviously we will be around and we'll be very happy to take those questions. Well, I say very happy, we'll be reasonably happy to take the question. If your question hasn't been answered today, please do look out for the feedback form, which will be emailed to you over the next few days, because there's going to be a further opportunity for you to ask a question there. Can I just conclude, therefore, by thanking all of our speakers, who I think have done a terrific job today, and crucially for thanking you, both the people in the audience here and the people who've been attending virtually, for your participation. We do this for you, the members, and therefore we are really very keen to get feedback from you to hear whether this has been what you needed, whether we could do it better next year or so forth. With that, I will declare the session over and break for lunch. If you could please go back through the doors in the middle, you will find lunch waiting.